You know, usually when I open up an earnings report and I see a company missed its revenue target by like over $1 billion, I don't keep reading.
Yeah.
I just assume something went fundamentally wrong. I close the tab and I move on.
It's a pretty standard reflex. You see flashing red numbers, you see a stock price dip, and the reptile brain just says danger.
Exactly. And that is precisely what happened with Sunoco LP on February 17th. They dropped their Q4 and full year 2025 report, and the headlines were just brutal.
Oh, they were?
I'm looking at MarketBeat, Bloomberg. They all flagged a massive miss on earnings per share. The consensus estimate was $1.64. Sunoco reported 9 cents.
9 cents.
Yes.
Wow. That is a painful delta to look at on a spreadsheet.
It's a catastrophe on paper.
Yeah.
And yet, and this is why we're doing a deep dive on this, if you actually listen to the management team or look at the debt markets or the cash, it's like they're living in a parallel universe.
Right.
They're calling 2025 a transformative year. They're using words like record-setting and home run, so I feel like I'm being gaslit here. Is this company in trouble, or is this the greatest sleight of hand in the energy sector?
It is definitely not a sleight of hand, but it is a massive paradox. It's a classic case of, noise versus signal.
Okay.
If you stop at the headlines, you see a struggling fuel distributor that just can't hit its targets. But if you actually open the transcript in the financial tables, you see a company that has fundamentally changed its DNA in the last 12 months.
Okay, so our mission today is to figure out which reality is the true one. We're going to look at the Sunoco LP Q4 2025 earnings to figure out how a company misses estimates by that much, but still claims to be having the best year in its history.
And, more importantly, how your local gas station distributor somehow quietly became a global infrastructure giant.
Operating in 32 countries, it's incredible.
It really is.
But before we get to the global empire stuff, we have to address the elephant in the room. We can't just wave away a $1 billion revenue miss or that EPS drop. That money didn't just vanish into thin air. Where did it go?
Well, it didn't vanish. It was spent. In the world of heavy infrastructure and M&A mergers and acquisitions, EPS is a notoriously messy number.
Why is that?
Because it includes all the messy accounting of buying things. You have to look at the calendar.
The calendar.
Specifically, Halloween 2025, October 31st. That's the day Sunoco closed the acquisition of Parkland Corporation. This wasn't just buying a competitor. This was a massive, multi-billion-dollar absorption of assets.
So the fourth quarter was basically moving day for the company.
Exactly. And think about the last time you moved houses. You've got the movers, you have the closing costs on the new place. Maybe you break the lease on the old one. For that 1 month, your bank account looks terrible. You spent a fortune.
Right. If someone looked at my finances in the month I bought a house, they'd think I was going broke.
That is exactly what happened here. When you look at that 9-cent earnings number, it's weighed down by about $60 million in one-time transaction expenses.
Lawyer fees, banker fees.
Integration costs, all of it. That all gets subtracted from the bottom line in the quarter it happens.
Okay, so that's the bill for buying the new house.
Right. But as an investor, you shouldn't care about the moving costs. You should care about the value of the new house. So if you strip out those one-time fees and look at adjusted EBITDA, which is really the proxy for the actual cash the business generates from operations, the picture just flips completely.
Okay, give me the numbers.
Q4 adjusted EBITDA was $706 million, a record. For the full year, they hit $2 billion. That's up 36% year over year.
36% growth. For a fuel distributor, that sounds improbably high. I mean, usually these are sleepy businesses that grow at the rate of inflation. You sell a little more gas, you make a few pennies more. How do you jump 36%?
That's the old Sunoco. And that's the disconnect the market is struggling with. The miss on revenue is largely accounting noise. And lower commodity prices, gas was cheaper, so total revenue looks lower. But the profit they kept from every gallon, that is where the story gets wild.
I want to drill into that. Because in the report, there was a specific metric that jumped out at me, and honestly, I thought it was a typo. Fuel margin.
This is the single most important number in the entire deck. You take nothing else away from this deep dive, you have to understand this number.
Okay, so in the third quarter, their fuel margin was 10.7 cents per gallon. Seems standard.
Pretty normal, yeah.
In the fourth quarter, after owning Parkland for just 2 months, that margin skyrocketed to 17.7 cents.
A nearly 70% increase.
How does that happen? I mean, did they just jack up prices at the pump and hope nobody noticed? Or did the price of oil crash and they just pocketed the difference?
No, No, that's not how it works. This is all about structural advantage. And to understand it, you have to understand what they actually bought with Parkland. They didn't just buy more gas stations in like Texas or Ohio where competition is fierce.
Right.
They bought a fortress in Canada.
A fortress. That's a strong word for a bunch of gas stations in the cold.
It's accurate, though. Canada is a totally unique market. In the U.S., if you want to open a gas station, you find a corner, you get a permit, and you build. It's hyper-competitive. Margins are razor thin because there's always a guy across the street trying to undercut you.
Right, the gas wars.
Canada is different.
Yeah.
You have incredibly high real estate costs, much stricter environmental regulations. It is a nightmare to enter that market as a new player.
So if you're already there?
It's a paradise because nobody can come in and challenge you. Austin Harkness, the chief commercial officer, he talked about this on the call. He compared the Canadian market to the U.S. Northeast or the West Coast. These are high barrier markets.
And because there's less competition?
The margins are stickier, meaning they don't fluctuate wildly. When oil prices go up or down, the margin just stays fat. And crucially, Parkland gave them street margin.
Okay, define that for me. Street margin versus what?
Versus wholesale margin. So Sunoco traditionally was largely a wholesaler. They made money on the spread between the refinery and the gas station operator, pennies on the gallon.
Just moving the fuel.
But street margin means capturing the profit all the way to the consumer's tank.
So they're getting the retail profit too.
In Canada, yes. They're capturing a bigger slice of the total value chain. They aren't just the middleman anymore. In these markets, they own the destination.
So instead of making 3 cents moving the gas, they're making 17 cents selling it.
Precisely. And that blended margin mixing, the huge volume of the U.S. wholesale business with this high-margin Canadian retail business, is what drove that number to 17.7 cents. And management thinks this is sustainable. This isn't a blip. This is the new baseline.
That creates a weird dynamic, though. If they're making that much money per gallon, do they even care about volume? I mean, usually companies brag about selling more stuff.
Well, volumes were up because of the acquisition. But here's the nuance. Sunoco is shifting from a pure volume story to a margin story. They would rather sell a few less gallons if they can make 17 cents on them than fight a price war to sell a billion gallons at 4 cents.
Quality over quantity.
In a way, yes. But they're getting quantity too. I mean, this acquisition made them the largest independent fuel distributor in the Americas.
The largest in the Americas. That feels like a big shish. I still think of them as the NASCAR sponsor or the logo on a pump in New Jersey.
They are way beyond NASCAR now. We need to talk about their footprint. They are now in 32 countries.
32. I saw that in the report. I just assumed most of that is small stuff, like a random tank in a port somewhere.
Some of it, sure. But there are pockets of explosive growth that you would never expect from a utility-style stock.
Yeah.
We need to look at the Caribbean segment.
Okay, the Caribbean. I see Caribbean in a financial report, and I usually just tune out. I think cruise ships, tourism. I assume it's a nice little side business supplying diesel to hotels.
That's what most people think. But hidden in that segment are two countries, Guyana and Suriname.
I've heard rumors about Guyana being the new hotspot.
It's not a rumor anymore. It's an economic miracle. Guyana has had 20% annual GDP growth for the last 3 years.
Wait, 20%? That sounds like a typo. Not even China in its prime did that.
No typo. It's offshore oil. Massive discoveries. The country is effectively industrializing overnight. And Sunoco's right there. Now, they aren't drilling for the oil that's Exxon and the big boys. Sunoco is handling the logistics.
So while Exxon pulls the oil out of the ground, Sunoco is bringing the fuel in.
Exactly. You need diesel to run the trucks, the cranes, the construction equipment to build the roads and the cities. You need gasoline for the new cars people are buying. Sunoco is building the terminals to bring fuel into the country to power this explosion.
So they're selling shovels in a gold rush.
That is the perfect analogy. While everyone in the U.S. is worrying about, oh, is gasoline demand going to drop by 1% because of EVs? Sunoco is sitting in a market that is growing at 20% a year.
That is a serious hedge. If the U.S. slows down, Guyana pays the bills.
It's a brilliant diversification. They mentioned Suriname is likely the next shoe to drop. Similar geology, similar potential boom.
So we have the Canadian fortress, we have the Caribbean boom towns, and then I saw they closed a deal in Europe, too.
Canquit. Closed in January 2026. This gives them terminal infrastructure in Europe. Again, it's all about diversifying away from being just a U.S. gas distributor.
But this brings up a risk I need to ask about. And honestly, this one makes me nervous. In this earnings report, I noticed they changed the reporting structure. They added a fourth segment, refining.
Refining segment.
Now, hold on. The whole pitch of Sunoco for the last decade, the reason people felt safe owning it was, we are not a refiner. Refiners are volatile. They live and die by the crack spread. It's a roller coaster.
Right.
Why on earth would they buy a ticket on that roller coaster now?
That is exactly the question analysts were asking. They acquired a refinery in Burnaby, Western Canada, as part of the Parkland deal. But, and this is key, Joe Kim, the CEO, was very specific about this. They are not running this as a merchant refinery.
What does that mean, a merchant refinery?
A merchant refiner operates to make a profit on the refining itself. They try to buy crude low and sell gas high, betting on the market spread. Sunoco is saying, we aren't doing that. They're using this refinery purely for supply security.
Explain that distinction.
Imagine you own a massive chain of gas stations in a remote part of Western Canada. It's hard to get fuel there. If you rely on someone else to sell you gas and the supply gets tight, you get squeezed. You might run out of product at your stations.
So by owning the refinery, they guarantee their own supply.
It feeds the distribution beast.
Okay.
It's a cost center that protects the profit center. In fact, they mentioned they started a 50-day maintenance turnaround in late January. They are investing money into it to make it reliable, not to gamble on oil prices.
So they don't care about the crack spread?
Not as much as they care about keeping the tanks full at their stations so they can capture that 17-cent margin we talked about.
Okay, that makes more sense. It's an insurance policy, not a casino bet.
It's vertical integration. It's the ultimate logistics flex. They own the terminals, the pipelines, the refinery, and the stations. They capture the margin at every single step.
Let's talk about how they pay for all this. Because transformative usually means expensive. They just bought Parkland. They are spending money in Guyana. They are fixing up a refinery. Are they maxed out?
You would think so. But this brings us to the financial strategy. Joe Kim calls it defensive growth.
Which sounds like an oxymoron. You're either defensive safe, boring slow, or you're growth risky, exciting. How can you be both?
He argues they are both. The defensive part is the contract structure. A lot of their income is locked in with long-term real estate leases and supply contracts. It's stable. The growth comes from the checkbook.
And they have a specific target for that checkbook.
A floor. They set a floor of $500 million per year for acquisitions.
Wait, $500 million a year is the minimum they plan to spend?
Correct. That's for bolt-on acquisitions, buying smaller distributors to add to the pile. Plus, they have another $600 million earmarked for capital projects. So over $1 billion a year in investment.
Do they actually have the cash, or are they putting this all on the credit card?
Surprisingly, they have the cash. Even after the massive Parkland deal, their leverage ratio is back down to around 4 times EBITDA, which is their long-term target. And they have about $2.5 billion in liquidity.
That's a lot of dry powder.
It is. And it tells you that Parkland wasn't the end of the story. It was just a chapter. They are ready to buy again.
And when they buy, they claim they can run things better than the previous owners, which is always what companies say, but do they actually deliver?
They call it synergies. That's the magic word. They expect $250 million in synergies from the Parkland deal.
Where does that money come from?
It's the unsexy stuff. Cutting duplicate HR departments, combining IT systems, using their massive scale to buy fuel cheaper than Parkland could. Management said they are betting the over on these targets.
Betting the over?
They expect to beat that $250 million number. They expect to see $125 million of that benefit show up in 2026 alone. They're very confident.
Now, for the listener who owns this stock or is thinking about it, usually they care about one thing above all else, the distribution, the dividend.
Show me the money. And Sunoco knows that. They raised the distribution again. It's the 5th consecutive quarterly increase. It's now sitting at just over 93 cents per unit.
And did they give any guidance on future raises, or is this just a one-time treat?
They are targeting at least 5% annual growth in the distribution.
In a world where interest rates are fluctuating and the economy is weird, a guaranteed 5% raise every year is nothing to sneeze at.
It's very attractive. But there is a catch, or rather a complexity, that we have to address. The tax thing.
Oh, right, the dreaded K-1 form.
This is the barrier for a lot of people. If you buy ticker symbol SUN, you're buying a master limited partnership. Come tax season, you get a Schedule K-1. It's complex, accountants hate it, and you generally can't own it in an IRA or a 401k.
Which keeps a lot of big institutional investors and retirement accounts away from the stock.
Exactly. It limits their pool of investors. So Sunoco has this dual structure. There is SUN, the MLP, And then there's SUNC Sunoco Corp.
I always get asked about this. How does SUNC work? Is it a different company?
No, it's the same underlying assets. But SUNC is a C Corp. If you buy SUNC, you get a regular 1099 tax form, just like buying Apple or Ford. No tax headache. You can put it in your IRA, no problem.
But usually, C Corp have to pay corporate taxes. So if the corporation pays tax, that leaves less money for the dividend, right? It's double taxation.
That's the magic trick here. During the call, they clarified that SUNC expects to pay minimal corporate taxes for at least the next 5 years.
How is that legal?
Depreciation. Sunoco owns massive physical assets. Pipelines, terminals, tanks. These things depreciate on paper. They can write off that depreciation against their income. So on paper, the corporation doesn't make enough taxable profit to owe the IRS, even though they are generating tons of actual cash.
So SUNC can pay the exact same dividend as the MLP.
Exactly the same payout. It opens the door for pension funds, retirement accounts, and retail investors who are scared of K1s to finally buy into the Sunoco story without the headache.
That is a very smart piece of financial engineering. It basically widens the funnel for who can buy their stock.
It does. And judging by the questions on the call, analysts are starting to pay a lot more attention to SUNC.
I want to pivot to something a little lighter that came up in the Q&A. We've talked about billions of dollars and global strategy, but the CEO, Joe Kim, had a moment where he sounded just like a frustrated commuter.
Yeah, the start-stop engine feature.
I hate that thing. You pull up to a red light, your engine dies, the AC gets weak, and then it shudders back to life when you hit the gas. It drives me crazy.
Well, it turns out Joe Kim hates it too, but he brought it up in a very specific context. There was a question about the rescission of the greenhouse gas endangerment finding.
Okay, translate that from bureaucrat speak to English for me.
Basically, the government might roll back some environmental regulations that force car makers to make engines ultra-efficient. If those rules go away, car makers might stop putting that annoying start-stop tech in cars just to save a fraction of a gallon of gas.
And Joe Kim joked that he'd be happy to see it go.
He did. But the business point was more interesting. He said, effectively, we don't care.
They don't care if environmental regulations get rolled back.
Or if they get stricter. This is what we call the complexity mode.
Explain that.
If regulations get stricter, say, requiring more ethanol blending, different rules for California versus Texas, it becomes a logistical nightmare. A small distributor can't handle that paperwork or the blending infrastructure. They don't have the chemists or the lawyers.
So the small guys go out of business.
And Sunoco buys them. Sunoco has the scale to handle the red tape, so strict regulations actually help them consolidate the market.
And if regulations get looser, like this rollback they were discussing?
Then gas is cheaper, cars burn more of it because they don't have the start-stop engines, and Sunoco sells more volume.
Heads they win, tails they win.
That's the argument. They view regulatory complexity not as a risk, but as a barrier to entry that protects them from competition.
It's fascinating to think of bureaucracy as a competitive advantage.
Only if you're big enough to handle it.
Ow!
And Sunoco is now definitely big enough.
So let's zoom out and summarize this deep dive. We started with a headline about a miss, a scary billion-dollar miss. But what we found when we dug in was a company that is intentionally shedding its old skin.
They've moved from a U.S. wholesaler to a Pan-American infrastructure giant.
They've secured a fortress market in Canada that boosted their margins to nearly 18 cents a gallon, which is unheard of for them.
They've planted flags in high-growth economies like Guyana that are growing at 20% a year, completely insulating them from U.S. demand issues.
And they've done it all while keeping their debt manageable and promising a 5% raise to investors every year with a tax-advantaged way to buy it.
The miss was just the cost of admission for this transformation. It was the moving costs.
Which leaves us with one big question for you, the listener, to chew on. And this is the one that keeps me looking at the ticker.
What happens next?
Right. They have $2.5 billion in liquidity. They have a mandate to spend at least $500 million a year. They are now comfortable operating in South America and Europe.
So, is defensive growth really the right term? Or are we looking at the early stages of a global empire builder? If Sunoco decides to buy something in Europe next or expand further into South America, they stop being a fuel distributor.
And they start looking a lot more like a global energy logistics major. Are they the next Glencore or Trafigura, just disguised as a gas station company?
With that much dry powder and that much ambition, I wouldn't bet against it. They have the assets, they have the cash, and they have the map.
A sleeping giant that just woke up in 32 countries. We'll be watching closely to see what they buy next.
Thanks for listening to The Deep Dive.
Catch you on the next one.